While the Western world was sleeping, and while every financial analyst was focused on tech stocks and AI hype, something impossible just happened in the Asian markets. A metal that's been suppressed for 50 years, a commodity that the banks told you was dead, just overtook the second most powerful technology company on Earth. $4.65 trillion. That's not a typo. And if you think you've missed it at $80 per ounce, you haven't seen the mathematics yet, because according to every historical valuation model, according to the physics of capital rotation, and according to what's happening right now in the COMEX vaults, this is just the beginning. The banks have 60 days. The inventory is vanishing, and the target isn't $100. It's $200. But there's something the mainstream media isn't telling you about why this is happening right now. Welcome to Currency Analyzer. Before we dive into the numbers that will reshape your understanding of this market, I need to ask you something important. If you've been watching financial markets for more than a decade, if you remember what real money looked like before everything became digital, then you understand why what I'm about to share with you matters. This channel exists for people who think beyond the headlines, so if that's you, do me a favor. Press that subscribe button right now. Not for the algorithm, but because the information we're about to cover doesn't stay relevant for long. Markets move fast these days, and I want to make sure you don't miss what's coming next. Also, drop a comment below and tell me, where in the world are you watching this from? Because what's happening in the silver market right now, it's affecting every economy, every currency, and every portfolio on the planet. Now, let's talk about what January 7th, 2026 really means, and why the Nvidia flip is just the beginning of something far bigger. On the morning of January 7th, 2026, financial analysts across Asia opened their trading terminals to a number that should not have existed. Silver's total global market capitalization had crossed $4.65 trillion. For a brief moment in the early Asian session, this meant that silver, the physical metal, was worth more than Nvidia, the second most valuable technology company in the world. Most investors scrolled past the headline without understanding what they were looking at, but the professionals who built their careers on understanding capital flows, they stopped everything. Because this was not supposed to happen. Nvidia represented the future of artificial intelligence. It was the company that powered every major tech breakthrough of the decade. Every pension fund owned it. Every wealth manager recommended it. It was the safest bet in the modern economy. And yet, a metal that most people associated with jewelry and old coins had just surpassed it in total value. The analysts began running the calculations again, checking for errors in the data feeds, but the numbers were correct. Silver had claimed the number 2 spot in the global asset hierarchy, sitting just below gold and above everything else. Above Apple, above Microsoft, above Saudi Aramco, above every oil company and every technology giant that dominated the headlines for the past 15 years. This was not a glitch in the system. This was the system announcing a fundamental change. For decades, the financial world operated on a simple belief. The belief was that the future belonged to companies that created intellectual property, software, and innovation. Physical assets, things a person could hold in their hand, were considered relics of the past. They were the tools of the old economy, not the new one. So if that's you, do me a favor. Press that subscribe button right now. Not for the algorithm, but because the information we're about to cover doesn't stay relevant for long. Markets move fast these days, and I want to make sure you don't miss what's coming next. Also, drop a comment below and tell me, where in the world are you watching this from? Because what's happening in the silver market right now, it's affecting every economy, every currency, and every portfolio on the planet. Now, let's talk about what January 7th, 2026 really means, and why the Nvidia flip is just the beginning of something far bigger. On the morning of January 7th, 2026, financial analysts across Asia opened their trading terminals to a number that should not have existed. Silver's total global market capitalization had crossed $4.65 trillion. For a brief moment in the early Asian session, this meant that silver, the physical metal, was worth more than Nvidia, the second most valuable technology company in the world. Most investors scrolled past the headline without understanding what they were looking at, but the professionals who built their careers on understanding capital flows, they stopped everything. Because this was not supposed to happen. Nvidia represented the future of artificial intelligence. It was the company that powered every major tech breakthrough of the decade. Every pension fund owned it. Every wealth manager recommended it. It was the safest bet in the modern economy. And yet, a metal that most people associated with jewelry and old coins had just surpassed it in total value. The analysts began running the calculations again, checking for errors in the data feeds, but the numbers were correct. Silver had claimed the number 2 spot in the global asset hierarchy, sitting just below gold and above everything else. Above Apple, above Microsoft, above Saudi Aramco, above every oil company and every technology giant that dominated the headlines for the past 15 years. This was not a glitch in the system. This was the system announcing a fundamental change. For decades, the financial world operated on a simple belief. The belief was that the future belonged to companies that created intellectual property, software, and innovation. Physical assets, things a person could hold in their hand, were considered relics of the past. They were the tools of the old economy, not the new one. Investors were taught to buy growth. They were taught to invest in ideas and potential in the digital revolution. And for years, that strategy worked beautifully. Tech stocks went up, real estate went up, anything tied to debt and leverage went up. But something changed in the structure beneath all of that growth. The analysts who understood monetary systems, the ones who studied central bank balance sheets and debt to GDP ratios, had been warning about this moment for years. They said the everything bubble could not last forever. They said that when the debt reached unsustainable levels, capital would rotate. It would move away from speculative assets and into hard assets. It would move away from promises and into certainty. And on January 7th, 2026, the market confirmed they were right. The Great Rotation had begun. But what does that phrase actually mean? What is a rotation, and why does it matter? In simple terms, a rotation is when institutional money, the trillions of dollars managed by pension funds, sovereign wealth funds, and central banks, shifts from one type of asset to another. For the past 15 years, that money flowed into stocks, especially technology stocks. Investors sold their commodities, their gold, their inflation hedges, and they bought shares of companies like Nvidia, Tesla, and Amazon. They did this because interest rates were at zero. Borrowing money was free, and in that environment, growth stocks performed the best. But now, the environment was changing. Debt levels were no longer manageable, interest rates were no longer at zero, and inflation was no longer transitory. The institutional investors began to realize something terrifying. They realized that stock prices were not rising because companies were becoming more valuable. They were rising because the currency itself was losing value. And when a currency loses value, there's only one safe place for capital to go: physical assets. Things that cannot be printed, things that cannot be inflated away, things that hold their value regardless of what any government or central bank decides to do. Gold had always been the king of that category. But silver, the smaller, more volatile cousin of gold, was now entering the spotlight. And here is where the mathematics became dangerous. The stock market is enormous. It holds tens of trillions of dollars in value. But the silver market is tiny. The total amount of investment-grade silver available in the world could fit into a handful of warehouses. So when institutional money begins rotating out of stocks and into silver, it creates a pressure that the market cannot absorb. Imagine trying to pour an ocean through a garden hose. The pressure does not just build, it explodes. And that explosion was exactly what the early Asian session data was showing. Silver was not just rising in price, it was absorbing capital at a rate that defied historical precedent. The professionals watching their screens that morning understood what this meant. The rotation was not a theory anymore. It was happening in real time, and it was only the beginning. There was something the financial media was not telling the public about the $80 price tag on silver. They called it expensive. They called it overheated. They told investors to be cautious because the metal had already rallied too far, too fast. But the analysts who actually understood monetary history were saying something completely different. They were saying that $80 was not expensive at all. In fact, according to the mathematics of purchasing power, $80 per ounce was a 50% discount. And to understand why, one had to go back to 1980. That year marked the last time silver reached what the mainstream called its all-time high. The price hit $50 per ounce during a period of extreme economic chaos. Inflation was rampant. The dollar was collapsing. And investors around the world rushed into precious metals as a form of financial survival. $50 in 1980 sounded like a lot. But here was the problem with that number. $1 in 1980 was not the same as $1 in 2026. Most people did not think about this when they looked at price charts. They saw silver at $50 in the past and silver at $80 today, and their brains automatically assumed that 80 was higher than 50. But that was an illusion created by currency debasement. In 1980, a middle-class family could buy a decent house for $60,000. In 2026, that same house cost $600,000. In 1980, a brand new car cost around $5,000. In 2026, that same car cost $50,000. The currencies had lost 90% of its purchasing power over those 46 years. So when analysts said silver hit $50 in 1980, they were not comparing apples to apples. They were comparing $1980 to $2026 as if they were the same thing. They were not. The economists who specialized in inflation adjustments ran the calculations using the government's own official consumer price index. And what they found was striking. $50 in 1980, when adjusted for the official inflation rate, equaled approximately $170 in 2026 purchasing power. That meant silver's true all-time high. The real peak when measured in constant dollars was not 50, it was 170, and silver was currently trading at 80. That was less than half of its historical peak value. But the story became even more interesting when analysts used alternative inflation measures. The government had changed the way it calculated inflation multiple times since 1980. Each time, the changes made inflation appear lower than it actually was. This was not a conspiracy theory. It was documented policy. The methodology was altered to reduce cost of living adjustments for Social Security and other entitlement programs. Independent economists who tracked inflation using the original 1980 methodology, the same formula the government used back then, came up with very different numbers. Using that older, more honest calculation, $50 in 1980 equaled over $400 in 2026. $400. That was the real inflation-adjusted all-time high for silver, and the current price was 80. So when the media called silver expensive, they were either ignorant of basic economics, or they were deliberately misleading the public. The metal was not expensive. It was trading at an 80% discount to its real historical value. This created a mathematical setup that serious investors could not ignore. Silver was not just undervalued, it was suppressed. And suppressed assets, when they finally break free, do not rise slowly, they explode. The target price of $200 per ounce that some analysts were forecasting was not a wild speculation. It was not a moonshot based on hype. It was simply mean reversion. Mean reversion is a concept every professional trader understands. It means that when an asset trades far below its historical average for an extended period, it eventually snaps back to that average, sometimes violently. Silver had been held below its inflation-adjusted average for 46 years. That was 2 full generations of suppression. And now, with institutional capital rotating into physical assets, with central banks printing currency at unprecedented rates, and with supply constraints tightening across every commodity market, the snapback was beginning. The move from $80 to $200 was not a gamble. It was math. It was the market correcting a decades-long distortion. And for investors who understood this, the current price represented one of the rarest opportunities in modern financial history. Because once silver crossed $100 per ounce, the psychology would shift. The masses would wake up, the headlines would change, and the fear of missing out would drive a stampede of capital into a market that could not physically absorb it. By then, it would be too late. The dealers would run out of inventory. The premiums would skyrocket. And the people who waited for confirmation would find themselves priced out of the very asset they should have bought when it was still affordable. $80 was not the top. It was the last gift the market was giving to those paying attention. There was a place in New York where the official price of silver was supposed to be determined. It was called the COMEX, the Commodities Exchange, and it operated like the central nervous system of the precious metals market. Every day, traders bought and sold contracts representing millions of ounces of silver. Most of these contracts were paper agreements, promises to deliver metal at a future date. Very few people actually demanded physical delivery. That was how the system was designed to work. But in January 2026, something went wrong. The traders who monitored the COMEX delivery reports began noticing an anomaly that should not have existed. January was supposed to be a quiet month. According to the standard futures calendar, January was classified as a non-delivery month. It was a dead zone where almost nobody stood for physical metal. The big players waited for the official delivery months like March, May, or September to settle their positions. Historically, January delivery volume was close to zero. But on January 7th, 2026, the official report showed that 4,697 contracts had stood for delivery. Each contract represented 5,000 ounces of silver. The math was simple but shocking. In just 72 hours, 23.5 million ounces of physical silver had been demanded from the COMEX vaults, in a month where nothing was supposed to happen. The professionals who understood what this meant immediately began making phone calls, because this was not normal market behavior. This was panic behavior. When sophisticated investors, the sovereign wealth funds and industrial giants who normally followed protocol, suddenly broke the rules and demanded early delivery, it meant only one thing. They no longer trusted the system to have metal available later. They were front-running a shortage. The COMEX operated on a fractional reserve model, similar to how banks operate. For every ounce of physical silver in the registered vaults available for delivery, there were multiple paper claims against that same ounce. The system worked as long as most people kept their silver on paper and did not ask for physical delivery. But when everyone started asking for the metal at the same time, the math stopped working. And that was exactly what was beginning to happen. The delivery notices showed something even more concerning. J.P. Morgan, one of the largest custodians in the COMEX system, had been forced to issue 63 delivery notices on a single day. JP Morgan was usually on the other side of this equation. They were usually the ones accumulating silver, not distributing it. For them to be issuing notices meant they were being squeezed. They were being forced to drain their own strategic reserves to meet demand they had not anticipated. 23.5 million ounces in 3 days was a massive hole in the system. But the real problem was not what had already been drained, it was what was coming next. January still had 3 more weeks remaining. If the current pace continued, 50 to 60 million ounces could be pulled from the COMEX before the month ended. If the current pace continued, 50 to 60 million ounces could be pulled from the COMEX before the month ended. And then March would arrive. March was a major delivery month. It was when the big industrial users, companies like Tesla and Samsung, traditionally locked in their silver supply for the year. The banks had built their entire risk model around the assumption that January would be quiet, giving them time to prepare for March. But the whales had stolen their preparation time, the buffer inventory was gone, and now the banks were staring at hundreds of millions of ounces worth of open interest in March contracts, with no clear way to source the metal. This created what traders called a delivery cascade. It worked like a bank run. When the first few customers withdrew their deposits, the bank was fine. But when other customers saw people withdrawing, they panicked. They realized that if they did not get their money now, there might not be any left later. So they joined the line. And the line created more panic. The industrial users watching the January drain were asking themselves a very simple question. If JP Morgan was struggling to deliver metal in a non-delivery month, what would happen when the real demand hit in March? The answer was obvious. They would not wait to find out. They would stand for delivery now while the system still functioned. This put the bullion banks in an impossible position. They had sold paper contracts for silver they did not physically possess. In normal markets, they could simply go to the open market, buy the metal, and deliver it. But the open market was broken. The Chinese were buying everything. The refineries were booked solid. The mines were producing at maximum capacity and still could not keep up with demand. If JP Morgan tried to buy 50 million ounces on the open market to cover their March obligations, they would send the price vertical. They would trigger the exact short squeeze they had spent decades trying to prevent. They were trapped. If they bought, the price exploded. If they did not buy, they defaulted. And default in the futures market did not look like bankruptcy. It looked like force majeure, a legal term meaning extraordinary circumstances beyond our control. The banks would send letters to contract holders saying they could not deliver physical metal due to unforeseen market conditions. Instead, they would offer cash settlement at the current spot price. But here was the problem with that solution. By the time the banks invoked cash settlement, the spot price would no longer reflect reality. There would be a COMEX price, where paper traded, and a street price, where physical metal actually changed hands. And those two prices would be very, very different. And the March delivery cycle was not just another month on the calendar. It was the potential breaking point of the entire paper-silver market. The countdown had already begun. 60 days remained, and the metal was vanishing faster than anyone had predicted. While the COMEX crisis was unfolding in the physical markets, a much larger force was driving the rotation into silver. It was a force that most retail investors did not understand because they were distracted by daily price movements and news headlines. But the institutional players, the sovereign wealth funds managing trillions of dollars and the central banks controlling national reserves, they understood it perfectly. The force was systemic risk. The United States national debt had crossed $36 trillion, and it was not slowing down. Every 100 days, another $1 trillion was added to the total. But the debt itself was only part of the problem. The real nightmare was hiding in the unfunded liabilities. Social Security, Medicare, and government pensions had promised benefits that exceeded $200 trillion in present value terms. There was no possible way to pay these obligations with tax revenue. The math did not work. The only solution was to print currency. And printing currency meant devaluation. The institutional investors managing other people's money, pension funds, responsible for retirees, endowments funding universities, they could see this reality clearly. They understood that holding dollars, or holding assets denominated in dollars, was a bet against physics. So they began looking for alternatives. They needed assets with zero counterparty risk. They needed something that did not depend on a government's promise, a corporation's balance sheet, or a financial system's stability. They needed atoms, not pixels. When an investor owned shares of Nvidia, what did they actually possess? They owned a digital entry in a brokerage database. That entry represented a claim on a company. But the claim itself depended on multiple layers of infrastructure remaining functional. It depended on the power grid working. It depended on the internet being accessible. It depended on the legal system enforcing property rights. It depended on the brokerage not going bankrupt. It was a chain of dependencies, and any broken link could erase the wealth. Silver was different. When someone held a physical ounce of silver, they held an atomic reality that had been recognized as wealth for 5,000 years. It required no counterparty. It required no system. It required no permission. It simply existed. And in a world where trust in institutions was collapsing, existence was the ultimate form of security. This realization was spreading through the institutional world like a slow-moving avalanche. The sovereign wealth funds of the Middle East were quietly rotating out of Western financial assets. The central banks of Asia were diversifying their reserves away from dollar-denominated bonds. They were not selling everything overnight. They were moving carefully, gradually, so as not to trigger panic. But the direction was clear. Capital was flowing out of paper and into physical. And then the media introduced a new narrative designed to confuse this reality. Every financial news channel began running stories about tariffs and trade wars. They said the Supreme Court was about to rule on international trade agreements. They warned that tariffs would crash the economy and destroy commodity demand. The headlines screamed that investors should sell their silver before the collapse came. But the analysts who actually understood economics knew this narrative was backwards. Tariffs were not deflationary. They were inflationary. When a government imposed a 60% tariff on goods from China, did that make products cheaper? No, it made everything more expensive. It broke supply chains. It forced companies to pay more for raw materials. It drove up costs across the entire economy. That was not deflation. That was stagflation, the toxic combination of rising prices and economic stagnation. And history had already shown what happened to silver during stagflation. In the 1970s, when the United States faced similar conditions, trade barriers, currency crisis, and inflation out of control, silver went from $1.50 per ounce to $50. It multiplied 33 times in less than a decade. The tariff narrative was not a reason to sell silver. It was confirmation that the currency system was failing and governments were resorting to desperate measures. But there was a critical distinction that every investor needed to understand. Not all silver exposure was created equal. If someone owned paper silver, an ETF, a futures contract, a mining stock, they were still inside the system. They still had counterparty risk. Their wealth still depended on brokerages, banks, and legal structures remaining functional. If the tariffs caused a banking crisis, if the Supreme Court froze certain assets, if the system experienced a shock, paper silver could be locked, confiscated, or converted to cash at unfavorable rates. But physical silver, metal held in personal possession, was outside that jurisdiction. It could not be frozen by a court order. It could not be confiscated by a brokerage. It could not be converted without consent. It was sovereign wealth in the truest sense. And that distinction was about to become extremely important. Because the silver market was approaching a psychological inflection point that would change everything. The number was $100 per ounce. Once silver crossed into triple digits, the perception would shift completely. The masses would wake up. The financial media would be forced to cover it. The fear of missing out would create a stampede. But by then, the dealers would be out of inventory. The premiums would be 20, 30, 40% above spot. And the people who waited for confirmation would discover that having money was not enough. The metal would simply be unavailable. This was the final accumulation window. $80 per ounce was not expensive. It was a 50% discount to inflation-adjusted fair value. It was a 75% discount to the alternative inflation calculations. And it was the last price at which physical silver could be acquired without extreme difficulty. The Nvidia flip was not just a trivia fact for market historians. It was the signal that marked the transition point between two eras. The era of digital wealth was ending. The era of physical wealth was beginning. The Great Rotation was not a theory anymore. It was visible in the market capitalization rankings. It was visible in the COMEX vaults. It was visible in the sovereign wealth fund allocations. And it was accelerating. The target of $200 per ounce was not speculation. It was mathematics. It was mean reversion after 46 years of suppression. The deadline was March. The inventory was vanishing, and the system was approaching its breaking point. For those who understood what was happening, the decision was clear. Get out of paper. Get into physical. Secure the asset before the window closed. Because once the masses realized what the institutions already knew, it would be too late. The rotation of the century had begun, and history would remember January 2026 as the moment when everything changed.